This is how you can slash your taxes using corporations if you are real estate investors with 2+ properties. Stay tuned, promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you joined me here today. This is the tax season, and you would be surprised the amount of times that I get asked questions about taxes. And generally, I would say defer to your accountant, but a lot of people just look to me for more about experience about how I deal with my taxes as an investor. So the two most common questions that I get from clients are this. One, should I incorporate in regards to the portfolio? Two, can I expense this? And this being some kind of expense that's incurred. And a lot of these questions come up around this time of the year. So I'm gonna answer the should I incorporate for a portfolio in this week's video, and next week I'll talk about the expenses. Remember, this is not tax advice, and I'm just sharing with you my personal experiences and also the conversations I've had with fellow investors and other clients. So do not take this as tax advice. Now, this one, the whole should I incorporate, is kind of difficult to give a blanket statement to everybody because everyone's tax situation is different, right? But I'll kind of try to do my best. But here's kind of the quadrant I want you to look at right up here. And I've made this so that you can find yourself on wherever you fit best on that quadrant chart, whatever, right? So here's my explanation of why I use this chart. Everyone thinks you can evade taxes. Tax evasion is illegal. Tax efficiency is what a good accountant does for you. So using corporation doesn't mean you pay less taxes. It just means that you can defer your tax liabilities into the future, meaning that if you have some money that you have to pay into taxes, you can pay that later and reinvest that money that you would have had in the corporation into growing your real estate portfolio. And they have this because they want to grow businesses and create more jobs. That's why they have it. So if you get paid in a corporation, doctors, dental practice owners, business owners, contractors, people who get paid, including HST, it makes sense for you to hold your real estate portfolio inside a corporation right off the bat. The main reason is this. If you create the proper tax structure, you can transfer your income that you earn between your corporations and start investing your earned income after paying the corporate tax rate, which is 11.5%. So for anyone who doesn't understand this whole corporation stuff, corporations are required to pay 11.5% tax on the first $500,000 that they earn in the corporation, as long as it's kept there, retained there. And then you just have to pay whatever tax afterwards if you pay yourself. However, if you do pay yourself, obviously there's going to be additional taxes, right? And it usually nets out to about the same thing through the tax integration rules, but you don't have to pay that balance of the tax just yet until you take it out of the actual corporation personally. Thus, you can reinvest that money that's already in the corporation. So meaning that for every dollar you make, you can invest 88.5 cents instead of paying it taxes first. So it makes sense for your first property and going forward to be inside a corporation. So if you're on the business income side where you collect HST, this is a pretty easy decision in my opinion. You could probably put your first property inside a corporation. If this is the type of real estate content you enjoy, then make sure you help us spread knowledge by smashing that like button and subscribing to the Prime Properties channel, because every single week we make awesome content like this, sometimes about taxes during tax season, and sometimes about updates of what's happening in the market, so that we can be transparent and honest to you, so that whenever you are ready to buy, sell, or invest in real estate, you'll be like, Zen and his team, you're going to book a consultation with us using this link right here on the screen. It's www.chatwithzen.com. Back to the tax stuff. So now for someone who's getting paid on payroll, meaning, like T4, this one's much more difficult to kind of navigate. Since you pay for all your taxes, which are take-home pay, you are generally left with less money to invest since you paid your taxes and deductions already because your employer took it. So if you're earning, say, 100 grand, you're paying about like 42 or 43% tax right off the bat, meaning every $100 you make, you can only invest 57 cents. That's a lot of a big difference compared to previously. Or if you're making over like 220, you're at the 50% tax bracket, meaning you could get 50 cents for every dollar you make. So you get less money to work with than the person who has a business, because that money can be saved up quicker in the corporation if you're paying less taxes right off the bat. And generally, this is where I stand in regards to someone in this situation. If you're going to buy your first investment property, I would just say don't bother with a corporation. The learning curve is already kind of hard enough to be a first-time investor, and for you to kind of pay accounting, understand it, do the legal, and then pay for the legal, it's probably just not worth it. And until you know for sure this is something you want to do, like own more investment properties, and you would really only know after you deal with the first one and deal with tenants, you don't really want to go down the rabbit hole of opening a corporation. This is at least what I advise most of my clients who work with me for the first time buying their first investment property. Now, once you've owned your first investment property and it makes sense to get more because you're like, oh, hey, I like this works, then you can consider a corporation. And one of the tax reasons for having a corporation is so that you can be more tax efficient. So again, not tax advice, but this is generally how it works. Rental income is taxable at 50%, regardless of your marginal tax rate. So it doesn't matter if you're making 100 grand or 250 grand. So what a lot of my clients do is they create a corporation that manages all their real estate properties. So call it the portfolio. And you can convert this income created by the portfolio that's taxed at 50% because it's passive rental income, and you convert it into an active income that's taxed at 11.5%, which is the management company, and that becomes the business. Then if you want to grow your portfolio some more, you create the infamous 3-tiered structure. So you have the hold co up here, the real estate co down here, then the management co over here, and then you can transfer earnings back and forth between the real estate holding co and the property management co so that you can use the earnings retained in both corporations for future down payments, and you continue growing your real estate portfolio from there. Now, if none of that makes any sense to you, that's generally normally what happens. You can repeat that whole little segment I just said because it's very difficult to understand, but it is a very powerful tool if you do it correctly, but only do it if it makes sense for you and you want to grow a portfolio. So meaning like 2+ or 3+ properties. I'm going to leave it at that because this stuff can get so much more complicated, and I'm not really a, tax accountant. So if you're looking for real estate help, whether it's to buy, sell, or invest, you can book a call with me using the link right here on the screen. It's www.chatwithzen.com. If you're looking to book a call with me and ask me tax questions, please don't. This is not my field. I'm just sharing you with my experience. Really go talk to a qualified accountant who understands real estate investing, which is very, very key. An accountant who understands real estate investing, because a good accountant is going to save you money. So invest in that relationship. As a pro tip, when you're finding an accountant, don't just start fishing around for free tax advice because it really pisses them off. So if you're looking for one, just interview them and ask the regular interview questions. And my final note for you is this: unfortunately, my accountant isn't taking any on new clients. So sorry, if I find a new one that's accepting, that's actually good. I'll let you guys know. But until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.